Hi everyone, welcome today. Today on day 93 of our challenge, we are getting granular and exploring the diverse landscape of mutual fund. Remember, mutual funds pool money from various investors and invest in the variety of assets offering diversification and professional management. But did you know that there are different types of mutual funds, each catering to specific investment goals and risk tolerance? Let's get deeper into it. Categorizing by asset class. The primary way to categorize mutual funds is based on the asset class they invest in. Equity funds. These funds invest primarily in the stocks of companies offering potential for high growth, but they also carry a higher degree of risk. Here is where things gets interesting. Within equity funds, there are further subcategories. Large cap funds focus on established blue chip companies with a proven track record, like Reliance Industries and Fossils. Mid cap funds they invest in companies with significant growth potential at mid-sized stocks like Marico, HDFC Bank. Small cap funds target smaller companies with the potential for high returns but also carry higher risk like Zomato, Nika. Multi-cap funds offer a balanced approach by investing across large, mid, and small cap companies. They provide a mix of risk and returns. Sectoral funds, they concentrate on a specific industry sector like technology, banking, or pharma. We will explore these in more in the future sessions. Thematic funds invest in companies across different sectors that are united by a particular theme, like clean energy or artificial intelligence. Now, let's look at the debt funds. These prioritize stability and income generation by investing in fixed income instruments like bonds. Debt funds also have subcategories. Like short term debt funds invest in debt instruments with maturities of less than 3 years, offering predictable returns with lower volatility, like treasury bills, commercial paper. Next option in debt category is long term debt fund. They invest in debt instruments with maturities exceeding 3 years, offering potentially higher returns but with greater interest rate risk. Gilt funds invest primarily in government bonds. It's considered one of the safest debt funds option, but with lower potential returns as compared to corporate bonds. Now let's discuss what is hybrid fund. These funds combine equity and debt investments, aiming for a balance between growth potential and income generation. So here are some types related to hybrid fund. First one can be balance fund. Balance fund invest in a mix of equity and debt, offering a balance of risk and return. The specific ratio of equity to debt can vary depending on the fund's objective. Then there are asset allocation funds under hybrid category. Actively managed funds where the fund manager adjusts the allocation between equity and debt based on market conditions. Children's fund, they invest in a mix of equity and debt with a longer time horizon suitable for saving for child's education or future needs. Now let's go beyond the basics. Index funds. These passively managed funds track a specific market index, offering a low cost way to gain exposure to diversified basket of stocks. Exchange traded funds. Similar to index funds, they trade on stock exchanges like individual stocks, offering greater liquidity. Tax saving funds, ELSS, equity linked savings schemes offered in India that provide tax benefits under Section 80C of the Income Tax Act. So remember, choosing the right top mutual fund depends on your individual circumstances. Consider your investment goals, risk tolerance, and investment horizon. Exploring these topics related to the mutual fund can equip you to make informed decisions for your financial future. Now, I want to hear from you. Which type of mutual are you most curious about? What questions do you have about building a diversified portfolio using mutual fund? Let's keep the conversation going in the comments below. Thank you for joining me today. Happy investing and see you tomorrow. Bye bye.